Hello, and welcome to our comprehensive guide on exploring the U.S. tax features of Xero accounting software. If you're a small business owner, an entrepreneur, or a freelance professional in the United States, you already know that navigating the world of taxes can be one of the most complex and demanding aspects of running your business. The forms, the deadlines, the ever-changing regulations, it can feel overwhelming. But what if you had a powerful tool designed to bring clarity and order to that chaos? That's where Xero comes in, and over the course of this series, we're going to explore how its features can help you manage your business's financial data with tax season in mind. Before we dive in, it is essential to state that this audio series is for informational and educational purposes only. It is not intended to provide, and should not be relied on for, tax, legal, or financial advice. The tax laws in the United States are incredibly complex and specific to your individual circumstances, business structure, and location. We strongly encourage you to consult with a qualified professional, such as a certified public accountant or a tax attorney, for advice tailored to your specific situation. Our goal here is to demonstrate the features within the Xero software, not to tell you how you should manage your taxes. So with that important understanding in place, let's begin. What exactly is Xero? At its core, Xero is a cloud-based accounting software platform designed specifically for small and medium-sized businesses. The term cloud-based is key here. Unlike traditional software that lives on a single computer, Xero operates online. This means you can access your financial data from anywhere with an internet connection, be it your office desktop, your laptop at home, or even your smartphone while you're on the go. This cloud-based nature is the foundation of its power. It allows for real-time collaboration. You can grant your bookkeeper or accountant access to your Xero account, allowing them to see the same data you see, at the same time. This eliminates the old, inefficient process of sending bulky data files back and forth, reducing the risk of errors and ensuring everyone is working from the most up-to-date information. When tax time comes, this collaborative feature becomes invaluable. Now, let's talk about the landscape of U.S. taxes for a small business. It's a multi-layered system. First, you have federal taxes, which are administered by the Internal Revenue Service, or IRS. Then you have state taxes, which vary significantly from one state to another. Some states have income tax, some have gross receipts tax, and some have none at all. On top of that, you might have local taxes at the city or county level. The type of tax you pay and the forms you file also depend heavily on your business structure. Are you a sole proprietor, where your business income is your personal income? Are you a partnership, an LLC, or limited liability company? Or perhaps an S corporation or a C corporation? Each of these structures has different tax implications, and while Xero can handle the bookkeeping for any of them, the way you interpret and use that data for tax filing will differ. This is why accurate bookkeeping is not just a good habit, it's the bedrock of tax compliance. The IRS requires you to keep detailed, accurate records of your income and your expenses. This is where Xero's primary function comes into play. It provides a system to record every transaction, categorize it, and store it in an organized fashion. One of the most fundamental concepts in business taxes is the idea of taxable income. In simple terms, your taxable income is your gross income minus your allowable business expenses, also known as tax deductions. A deduction is a business-related cost that you can subtract from your revenue, thereby lowering the amount of income that is subject to tax. Common examples include office supplies, software subscriptions, advertising costs, employee wages, and mileage for business travel. The challenge for many business owners is tracking all of these expenses accurately. A missed deduction is, in essence, a voluntary overpayment of your taxes. A shoebox full of crumpled receipts is a classic, but highly inefficient method of tracking. Xero offers a modern solution. By connecting your business bank accounts and credit cards to the software, it can automatically import every transaction. Your job then becomes one of review and categorization. You can set up rules to automatically categorize recurring expenses, and you can use the Xero mobile app to snap photos of receipts and attach them to the corresponding transaction right on the spot. This creates a clean, digital, and searchable record of your expenses, which is crucial for substantiating your deductions if you ever face an audit. Throughout this series, we will break down the specific Xero features that support these processes. We'll look at how to properly set up your chart of accounts, the backbone of your financial reporting. We will explore how to manage sales tax, a particularly complex area for businesses that sell goods or services across different states. We will dive into payroll features, expense tracking, and how to generate the key financial reports that you and your accountant will need, like the profit and loss statement and the balance sheet. Think of Xero as your financial data headquarters. It's the single source of truth for your business's financial activity. By diligently maintaining your records in Xero throughout the year, you transform tax preparation from a frantic, stressful scramble into a more orderly process of reviewing and utilizing the data you've already organized. In summary, this first chapter has set the stage. We've defined Xero as a powerful, cloud-based accounting tool. We've touched upon the complexities of the U.S. tax system and underscored the absolute necessity of meticulous record-keeping. And we've established that the purpose of this series is to be an educational tour of the software's features, not a substitute for professional advice. In our next chapter, we will roll up our sleeves and begin with the very first and most critical step: setting up your Xero organization for success in the U.S. market. We'll cover initial settings for your business information, financial year-end, and how to configure your tax basis. All foundational elements that will ensure the information you generate is accurate and useful. Thank you for joining me for this introduction. I look forward to guiding you through the next chapter. Welcome back. In our first chapter, we introduced Xero as a powerful cloud-based accounting platform and discussed the importance of diligent bookkeeping within the complex U.S. tax system. We established that organized financial data is the foundation of a less stressful tax season. Now, it's time to build that foundation. This chapter is all about the critical first steps: correctly setting up your Xero organization for the United States. Getting these initial settings right is one of the most important things you can do, as they affect every transaction you record from this point forward. As a brief but important reminder, this guide walks you through the features and settings available within the Xero software. It is for educational purposes only and should not be considered tax or legal advice. We will be discussing options like tax basis, which have significant financial implications. We highly recommend you make these decisions in consultation with a qualified accounting professional who understands the specific needs of your business. Let's begin by logging into your new Xero account. The first thing you'll want to do is navigate to your organization's settings. This is typically found by clicking on your organization's name in the top left corner and then selecting Settings. The first area to address is your organizational details. This may seem basic, but it's crucial. Here you will enter your business's legal name, trading name, address, and contact information. Why is this so important for taxes? Because this information is often used to auto-populate official documents, invoices, and reports that you might provide to your accountant or, in some cases, to government agencies. Ensuring your legal business name and address are correct from day one creates consistency across your financial records. This section might also be where you enter your employer identification number, or EIN, if applicable. Once your basic details are in, the next, and arguably most critical, area to configure is your financial settings. This is where you will make two fundamental decisions about how your business records its finances. First is the financial year end. For the vast majority of small businesses in the United States, the tax year is the calendar year. This means the financial year ends on December 31st. Xero will likely default to this, but it's essential to confirm it. If your business is a C corporation, you might have the option for a different fiscal year end, but this is something that should only be done with specific guidance from a tax professional. For most sole proprietors, LLCs, and S corporations, aligning with the December 31st calendar year end is standard practice. This setting dictates when Xero will close your books for the year and generate annual reports like the profit and loss statement, which are vital for filing your tax return. The second and more complex decision in your financial settings is your tax basis. Xero will ask you to choose between the cash basis and the accrual basis of accounting. This choice determines the timing of when you record income and expenses. Let's break down what these terms mean. Under the cash basis, income is recorded only when you actually receive the money in your bank account. Similarly, an expense is recorded only when the money actually leaves your bank account. It's based on the flow of cash. For example, if you send an invoice to a client in December but don't get paid until January, under the cash basis, that income is recorded in January of the new year. This method is often simpler and is used by many small businesses and freelancers because it closely mirrors the cash flow in their bank account. Under the accrual basis, on the other hand, income is recorded when it is earned, regardless of when the payment is received. Expenses are recorded when they are incurred, regardless of when you actually pay them. Using the same example, if you send that invoice in December, under the accrual basis, you record that income in December, even if the cash doesn't arrive until January. This method provides a more accurate picture of a company's financial health and performance over a specific period. and the IRS requires some businesses, particularly those that manage inventory, to use it. Choosing between cash and accrual is a significant decision with direct tax consequences. Xero can run reports on either basis, but your primary setting should match how you intend to file your taxes. Again, this is a perfect example of a decision that should be made with the guidance of your accountant. They can advise on which method is required or most advantageous for your specific business type and industry. After you've confirmed your financial settings, the next foundational element to review is your chart of accounts. Think of the chart of accounts as the backbone of your bookkeeping system. It's a complete list of all the categories, or accounts, that you use to classify your business's transactions. When you earn money, it gets categorized into an income account like sales. When you spend money, it gets categorized into an expense account like office supplies or advertising. Xero provides a default chart of accounts that is a great starting point. However, you will want to customize it to fit your business. You can add new expense accounts to track specific types of deductions you want to monitor. For instance, you might want to create separate accounts for software subscriptions, meals and entertainment, and business travel. The more detailed your chart of accounts, the clearer your financial picture will be, and the easier it will be for your accountant to identify potential tax deductions. Your accountant may even provide you with a specific chart of accounts they prefer to work with. Taking the time to customize this list properly at the beginning will save you countless hours of recategorizing transactions later. Finally, one of the most powerful setup steps is connecting your bank accounts via bank feeds. In the accounting menu, you'll find an option for bank accounts. Here you can add your business checking accounts, savings accounts, and credit cards. Xero uses secure connections to automatically import your transaction data every business day. This is a game changer. It eliminates the need for manual data entry and ensures that no transaction is missed. It turns bookkeeping from a data entry chore into a process of review and reconciliation. Each imported transaction will appear in your Xero dashboard, waiting for you to categorize it using your newly customized chart of accounts. To recap this chapter, we have walked through the 4 essential pillars of your initial Xero setup for the US. We started with the organizational details, ensuring your business information is accurate. We then moved to the critical financial settings, defining your financial year-end and understanding the choice between cash and accrual tax basis. We discussed the importance of customizing your chart of accounts to properly classify your transactions. And finally, we highlighted the power of setting up bank feeds to automate your data flow. By completing these steps carefully, you have built a robust and reliable framework for your business's finances. You've created a system designed for accuracy and efficiency. In our next chapter, Chapter 3, we will begin putting this framework to use. We'll explore the day-to-day reality of managing your income and expenses within Xero, focusing on how to correctly code transactions coming in from your bank feed to maximize the accuracy of your financial reports. Thank you for joining me. I'll see you in the next chapter. Hello and welcome back. In our previous chapter, we meticulously laid the groundwork for our accounting system by configuring Xero's organizational and financial settings, customizing our chart of accounts, and connecting our bank feeds. Now we get to see that preparation pay off. In this chapter, we're moving from setup to daily action. We will explore how to manage the flow of transactions that come in from your bank feed. This process, often called bank reconciliation, is the single most important recurring task you will perform in Xero to keep your financial records accurate and up to date. As always, please remember this session is an educational guide to the Xero software's functionality. The examples we use for categorizing transactions are for illustrative purposes only. How you categorize your specific business expenses should be determined in consultation with your accounting professional to ensure it aligns with your overall tax and bookkeeping strategy. Let's navigate to the Xero dashboard. The first thing you'll likely see is a box for your business bank account with a blue button that says Reconcile Items. This is your gateway. Clicking it takes you to the reconciliation screen. This screen is split into 2 columns. On the left, you see the bank statement lines, a list of all the money that has come in or gone out of your bank account, imported directly from your bank. On the right, you see what Xero has recorded in its system. Your goal is to make the right side match the left side for every single transaction. For each bank transaction on the left, Xero gives you 4 primary options on the right: match, create, transfer, and discuss. Let's look at each one. The first option is match. Xero is smart. If you have already entered a bill from a vendor or an invoice to a customer into the system, Xero will look at the date and amount of the bank transaction and try to find a match. For example, if you entered a bill for $100 from your web designer, and then a $100 payment appears in your bank feed, Xero will suggest a match in green. If it's correct, all you have to do is click OK, and the transaction is reconciled. This is common for businesses that use Xero's invoicing and bill payment features extensively. The most common option you will use, especially for day-to-day expenses, is Create. This is for transactions that don't already have a corresponding bill or invoice in Xero. Think of your trip to the office supply store, your monthly software subscription, or your fuel purchase for a business vehicle. When a new expense like this appears from your bank feed, you use the Create tab to tell Xero what it was for. The Create tab has 3 main fields you need to complete: the who, the what, and the why. The who is the contact. You can type in the name of the vendor, like the name of the gas station or the software company. Keeping this consistent is a good practice. The what is the account. This is where your customized chart of accounts from Chapter 2 comes into play. You click the drop-down menu and select the category that best describes the transaction. If you bought printer paper and pens, you would select your office supplies account. If it was a payment for your website hosting, you'd select dues and subscriptions, or a similar account. This is the most crucial step in categorization. Assigning the right account ensures your financial reports are accurate and meaningful. The why is the description. Here, you can add a note for yourself or your accountant. You could write new printer paper and toner, or monthly fee for project management software. You can also attach a digital copy of the receipt here, creating a complete, audit-proof record for that transaction. Once these fields are complete, you click OK. The third option is Transfer. You use this specifically when you move money between 2 of your own accounts that are both connected to Xero. For example, if you move $500 from your business checking account to your business savings account, in your checking account feed, you will see a $500 withdrawal. Instead of creating an expense, you select the Transfer tab and choose the savings account it went to. This tells Xero it wasn't an expense, but simply an internal movement of funds. The final option is Discuss. This is a collaborative feature. If you see a transaction and have absolutely no idea what it is or how to categorize it, you can type a message in the Discuss box and it will be flagged for your accountant or bookkeeper to review the next time they log in. Now you might be thinking that categorizing every single transaction sounds repetitive, and you'd be right. This is where Xero's efficiency tools come in. One of the most powerful is bank rules. You can create a rule for any recurring transaction. Let's say you pay $50 every month for a specific software subscription. Instead of manually creating that transaction every month, you can create a bank rule. From the reconciliation screen, you can find an option to create bank rule. You can set conditions. For instance, if the payee contains the word software company name, you can then tell Xero to always categorize it to the software subscriptions account and assign it to the software company name contact. Once you save that rule, the next time that transaction comes through your bank feed, Xero will automatically apply the rule and suggest the categorization for you. All you have to do is click OK. Investing a little time to set up bank rules for your regular, predictable expenses can save you hours of work each month. In summary, the bank reconciliation screen is your command center for daily financial management. By consistently matching, creating, and transferring your transactions, you maintain a real-time, accurate picture of your business's financial health. Properly assigning each item to the correct account in your chart of accounts is the key to generating useful reports. And by leveraging tools like bank rules, you can automate much of this process, turning bookkeeping from a chore into a quick, manageable daily habit. In our next chapter, we will build on this by exploring one of the most complex topics for many U.S. businesses: setting up and managing sales tax within Xero. Thank you for your time. I look forward to speaking with you in the next chapter. Hello, and welcome back to our series. In our last chapter, we established a solid routine for managing daily transactions through Xero's bank reconciliation features. Now we are going to tackle what is often one of the most confusing and challenging topics for businesses in the United States: sales tax. Before we go any further, it is absolutely critical to understand that this chapter is a demonstration of the tools Xero provides for calculating and tracking sales tax. It is not, in any way, a guide to your specific sales tax obligations. U.S. sales tax law is incredibly complex and varies dramatically by state, county, and even city. Whether you need to collect sales tax, from whom, and at what rate, depends on a legal concept called nexus. This is a connection your business has to a state that obligates you to follow its tax laws. Nexus can be established by having a physical presence, like an office or employee, or through economic nexus, which is triggered by exceeding a certain amount of sales revenue or number of transactions within a state. Determining where you have nexus is a legal and accounting question that is far beyond the scope of this educational series. We strongly urge you to work with a qualified tax professional to understand your specific responsibilities. Our goal today is simply to show you how to use Xero's features once you know what those responsibilities are. With that vital disclaimer in mind, let's explore the sales tax functionality within Xero. The first step is to enable the sales tax feature. You can do this by navigating to the accounting menu, selecting Advanced, and then clicking on Sales Tax. Xero offers an automated sales tax feature for the United States, which is a powerful tool. Instead of requiring you to manually look up and enter the tax rates for every location you sell to, Xero has partnered with a specialized tax compliance company to provide this information automatically. When you set up automated sales tax, you will need to provide your business's physical address. This serves as the ship from location. Once enabled, this feature works its magic when you create a sales invoice for a customer. Let's walk through that process. Imagine you are creating a new invoice. You'll add your customer, the products or services you sold, and the price for each line item. Then, in the tax rate column, you will see that Xero has a tax on sales option that is tied to this automated system. When you enter the customer's full address, specifically the street, city, state, and zip code, Xero sends this information to its tax calculation service in the background. The service then determines the precise, up-to-the-minute correct sales tax rate for that specific location, accounting for state, county, city, and any special district taxes. It then applies that rate to the taxable items on your invoice and calculates the sales tax amount automatically. This removes the guesswork and the risk of using an outdated or incorrect rate. The system is also capable of handling more complex situations. For example, some products might be tax-exempt in certain states, or you may be selling to a tax-exempt organization like a charity or a reseller. Within a customer's contact details in Xero, you can mark them as tax-exempt and even store their exemption certificate number. When you create an invoice for a customer flagged as exempt, the system will know not to calculate sales tax. After you've been invoicing customers and collecting sales tax for a while, you will need to remit that money to the state's tax authority. It's important to remember that the sales tax you collect is not your money. You are simply holding it on behalf of the government. This is where Xero's reporting features become essential. Under the Reports section, you will find the Sales Tax Report. This report is your central hub for sales tax information. It summarizes all the sales tax you have collected over a specific period, such as a month or a quarter, broken down by state. The report shows your total sales, your non-taxable sales, your taxable sales, and the total amount of tax you collected. This summary provides the exact figures you will need to fill out your sales tax return for each state where you are registered. After you have filed your return and paid the tax to the state, you can go back into the sales tax report in Xero and mark it as filed. This creates a historical record of your filings and helps you keep track of your obligations. In summary, Xero's approach to U.S. sales tax is to provide a powerful calculation and reporting engine. It automates the complex task of finding the correct rate for any given address and provides the clear, concise reports needed for filing. The process is: first, work with a professional to understand your nexus obligations. Second, enable and configure the automated sales tax feature in Xero. Third, apply the tax correctly to your sales invoices. And finally, use the sales tax report to gather your data for filing your returns. In our next chapter, we will dive deeper into the sales side of your business. We'll move beyond just sales tax and explore the full life cycle of invoicing and accounts receivable, including creating professional invoices, sending reminders for overdue payments, and applying payments as they come in. Thank you for joining me. I look forward to speaking with you in Chapter 5. Hello and welcome back. In our journey so far, we have built a strong foundation for our business's finances in Xero. We've configured our settings, learned to manage daily transactions, and tackled the complexities of sales tax. Now we turn to one of the most vital activities in any business: getting paid. In this chapter, we will explore the complete life cycle of invoicing your clients and managing your accounts receivable. That is, the money that is owed to you. As we proceed, please remember that while we will discuss features like invoice terms and payment reminders, this information is for educational purposes on how to use the Xero software. It is not legal or financial advice on how to manage customer credit or collections. The policies you set for your business should be your own. The heart of getting paid is the sales invoice, a professional, clear, and accurate invoice not only tells your customer what they owe but also represents your brand. Let's walk through creating one in Xero. From the main dashboard, you can click the plus icon at the top and select Invoice. This will open a new invoice template with several key fields. First is the To field, where you will enter your customer's name. If it's an existing customer, Xero will auto-populate their details. If it's a new one, you can add them on the fly. Next, you have the dates. The date field defaults to today, and the due date field is automatically calculated based on the payment terms you've set, for instance, net 15 or net 30 days. You can always override this manually for a specific invoice. Consistent and clear due dates are a key part of managing expectations with your clients. The invoice also has a unique invoice number, which Xero generates sequentially to ensure you never have duplicates. This is critical for record keeping. You can also add a reference number, like a customer's purchase order number, to help them with their own accounting. Now we get to the main body of the invoice. This is where you list the products or services you provided. Each line item has several columns. In the description, you provide a clear detail of the work done or the product sold. The quantity and unit price fields are multiplied to get the total for that line. One of the most important columns is Account. This is where you categorize the income. This links directly back to your chart of accounts. For most businesses, this will be a sales or service revenue account. Proper categorization here ensures your profit and loss report is accurate. Next to the account is the tax rate column. As we discussed in the last chapter, if you have automated sales tax setup, Xero will use the customer's address to apply the correct tax rate. If the item is non-taxable, you can select the appropriate setting here. Before you send your first invoice, you may also want to explore Xero's branding themes. Under Settings, you can upload your company logo, change fonts, and adjust the layout to create a polished, professional document that matches your brand identity. Once the invoice is complete and reviewed for accuracy, it's time to send it. You can email the invoice directly from Xero. This sends the customer a professional email containing a link to an online version of the invoice, as well as a PDF attachment. The online invoice is a powerful feature. It's a live document that will update from sent to viewed once your customer opens it, so you know it has been received. To help your business get paid even faster, Xero integrates with a variety of online payment gateways, such as Stripe, PayPal, and GoCardless. By connecting a payment service, a Pay Now button will appear on the online invoice. This allows your customers to instantly pay you via credit card, debit card, or an ACH bank transfer. This convenience can significantly reduce the time it takes for you to receive payment. After an invoice is sent, it becomes part of your accounts receivable. Xero provides excellent tools for tracking what you're owed. On your main dashboard, you'll see a graph showing invoices that are awaiting payment, including a clear visual of any that are overdue. You can also navigate to the Invoices section to see a full list, which you can sort by due date to see what's coming up or what is already late. For a more detailed view, you can run an aged receivables report, which shows you how long each invoice has been outstanding. For example, 1 to 30 days, 31 to 60 days, and so on. One of the most powerful features for managing this process is invoice reminders. Manually chasing late payments can be time-consuming and uncomfortable. Xero lets you automate it. In your invoice settings, you can set up a schedule of automated reminder emails. For example, you could set a friendly reminder to be sent 3 days before the due date, another on the due date, and perhaps a more direct one 7 days after it becomes overdue. You can customize the wording of these emails to match your company's tone. This feature helps you systemize your collections process in a professional and consistent manner. Finally, when the customer's payment does arrive in your bank account, the loop is closed during your bank reconciliation. The payment will appear in your bank feed, and Xero's match function will automatically suggest matching it against the outstanding invoice. With a single click of the OK button, the invoice is marked as paid, your accounts receivable is updated, and your books are perfectly in sync. In our next chapter, we will look at the other side of the cash flow equation, managing what you owe. We'll explore how to enter bills, track expenses, and manage your accounts payable to stay on top of your financial obligations.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Thank you for your time. I will see you in Chapter 6. Hello and welcome back. In the previous chapter, we focused on the income side of your business, covering how to create invoices and manage accounts receivable to ensure you get paid. Now we're going to flip the coin and look at the other side of your cash flow, managing your expenses and paying your bills. This process is known as managing your accounts payable, the money your business owes to its suppliers and vendors. Keeping track of this is just as crucial as tracking your income for maintaining a healthy business. As we go through the features for managing bills, please remember this is a guide to how the Xero software works. It is not financial advice on how to manage your business's debt, prioritize payments, or negotiate terms with your vendors. Those are business strategy decisions that you should make based on your specific circumstances. Let's begin with the first step, getting your bills into the Xero system. An unpaid bill is a liability, and your accounting system needs to know about it from the moment you receive it, not just when you pay it. Xero offers several ways to do this. The most straightforward method is manual entry. From the business menu, you can select Bills to Pay, and then click the New Bill button. The screen will look very similar to the invoice screen, but now the roles are reversed. In the From field, you'll enter the name of the vendor who sent you the bill. The date and due date fields are critical for tracking when the payment is due. You should enter the reference number from the bill you received, which helps you match it up later. In the main body of the bill, you will detail what you purchased. Just like with invoices, you'll fill out the description, quantity, and unit price. And again, the most important field here for your own records is the account column. This is where you categorize the expense by selecting the appropriate account from your chart of accounts. Was this for cost of goods sold, rent, utilities, or marketing expenses? Categorizing bills correctly at this stage is what ensures your expense tracking is accurate and your financial reports are meaningful. You can also attach a digital copy of the bill, creating a complete record. While manual entry works perfectly, Xero offers more automated and efficient methods. One of the most popular is the Bills to Xero feature. Xero provides you with a unique, secret email address for your bills. You can give this email to your vendors and ask them to send their invoices there directly, or you can simply forward any bills you receive in your own inbox to this address. Xero will then scan the attached PDF and use data recognition technology to automatically create a draft bill for you in your account. It will pull out the vendor's name, the date, the amount, and even the line items. Your job is simply to review the draft, check it for accuracy, assign it to the correct expense account, and approve it. This feature can be a massive time saver. Once a bill is in the system, it will have a status. It might be a draft, awaiting approval if you have a multi-step review process in your company, or awaiting payment. You can view all your bills from the Bills to Pay screen, which gives you a clear overview of what you owe and when it's due. You can sort this list by due date to see what payments are most urgent. When it's time to pay, Xero again provides tools to make the process efficient. If you only need to pay one bill, you can open it up and scroll down to the Make a Payment section, where you can record the date it was paid and from which bank account. However, the real power comes from batch payments. If you have 10 different bills due to 10 different vendors, paying them one by one from your online banking can be tedious. With Xero's batch payment feature, you can select all the bills you want to pay, and Xero will group them into a single batch. It can then generate a payment file in a format that is compatible with most major banks. You can then upload this single file to your online banking portal, which will process all the individual payments to your vendors. This systemizes your payment runs and dramatically reduces administrative time. The final step in the life cycle of a bill is reconciliation. After you've paid a bill, the payment will eventually clear your bank account and show up in your bank feed on the Xero dashboard. Just as customer payments are matched to invoices, your bill payments will be matched to the bills you've paid. Xero will see the outgoing payment of, say, $250 to your electricity provider and suggest matching it to the $250 electricity bill you entered. You simply click OK, and the bill is marked as paid, and your books are reconciled. In summary, Xero provides a comprehensive system for managing your accounts payable. From efficient data entry using email forwarding, to clear dashboards for tracking due dates, to powerful batch payment features, the software helps you stay organized and on top of your financial obligations. Now that we have covered how to manage both money coming in and money going out, it's time to see how Xero brings all this data together. In our next chapter, we will explore one of the most important outcomes of all this work, generating and understanding key financial reports. Thank you for your time. I'll see you in Chapter 7. Hello and welcome back. Over the past several chapters, we have been diligently working within Xero to set up our accounts, manage daily transactions, create invoices, and pay bills. Every action, every categorization, every reconciliation has been an act of building a rich financial database for your business. In this chapter, we get to see the payoff. We will explore how Xero transforms that raw data into powerful, easy-to-understand financial reports. These reports are the language of business, providing the insights you and your accountant need to gauge financial health and prepare for tax season. It is especially important in this chapter to reiterate our core principle. We are exploring the features of the software, not providing financial or tax advice. We will explain what these standard financial reports show and how to generate them in Xero. However, the strategic interpretation of these reports, using them to make business decisions, secure loans, or plan your tax strategy, should always be done in close consultation with a qualified professional like a CPA or financial advisor. Let's begin in the Reports section of Xero. You will see a long list of available reports, but we are going to focus on the essential ones that form the foundation of business accounting. First up is arguably the most referenced report, the Profit and Loss Report, which is also known as the income statement. The purpose of the profit and loss, or P&L, is to show your business's financial performance over a specific period of time. It answers the question, how profitable was my business last month, last quarter, or last year? When you run the P&L report in Xero, the first thing you'll do is select a date range. The report is structured very logically. At the very top, you have your income or revenue. This is the total of all the sales invoices you've issued and the money you've earned, categorized into the income accounts from your chart of accounts. Directly below that, you might have a section for cost of goods sold, which are the direct costs associated with providing your product or service. Subtracting the cost of goods sold from your income gives you your gross profit. Next, the report lists all your operating expenses. This is where all your diligent categorization of bills and expenses pays off. You'll see totals for everything from rent and utilities to marketing, software subscriptions, and office supplies. Finally, at the very bottom, Xero subtracts your total expenses from your total income to give you the bottom line, your net profit or net loss. This single number is a critical indicator of your business's profitability during that period. In Xero, you can also use the Compare Periods feature to run a P&L for this quarter and compare it side by side with the previous quarter, or the same quarter last year, helping you to spot trends in your performance. The second foundational report is the balance sheet. While the P&L shows performance over time, the balance sheet provides a snapshot of your business's financial position on a single, specific day. It answers the question, what is the financial health of my business right now? The balance sheet is based on the fundamental accounting equation. Assets equals liabilities plus equity. Let's quickly define those terms. Assets are what your business owns. This includes the cash in your bank accounts, your accounts receivable, the invoices your customers haven't paid yet, and the value of your equipment or property. Liabilities are what your business owes to others. This includes your accounts payable, the bills you haven't paid yet, any sales tax you've collected but haven't remitted, and any outstanding loans. Equity is the net worth of the business. It's what would be left over for the owner if all assets were sold, and all liabilities were paid off. It also includes any capital the owner has contributed to the business. When you run a balance sheet in Xero, you will see these three sections clearly laid out, and the total of your assets will always equal the total of your liabilities plus equity. This report is essential for understanding the overall value and stability of your company. Beyond these two cornerstone reports, Xero offers others that are vital for day-to-day management. We've mentioned the Aged Receivables Report, which is crucial for cash flow management as it lists all unpaid customer invoices and shows how long they've been overdue. Its counterpart, the Aged Payables Report, does the same for the bills you owe, helping you manage your payment schedule. Another incredibly useful report is the Cash Summary. This report shows the actual movement of cash in and out of your bank accounts. It can be very helpful because sometimes your profit and loss report might show a profit, but your cash flow could be tight due to outstanding customer invoices. The Cash Summary helps you track the real cash position of your business. A key feature of Xero's reporting is the ability to customize and export. Most reports allow you to change the layout, group or filter certain accounts, and add your own notes before publishing. Once you have a report you're happy with, you can easily export it as a PDF, an Excel spreadsheet, or a Google Sheet, making it simple to share with your accountant, a bank, or your business partners. In our next chapter, we'll discuss how to put these reports, and Xero as a whole, to work during the most critical time of year. We'll focus on the process of collaborating with your accountant or bookkeeper within the software to make tax preparation as smooth as possible. Thank you for your time, and I'll see you in Chapter 8. Hello and welcome back. Throughout this series, we have systematically built a clean, accurate, and up-to-date set of books for your business. We've seen how diligent data entry and categorization lead to powerful financial reports. Now we arrive at the ultimate purpose for much of this hard work, preparing for and filing your annual tax return. In this chapter, we will focus on how Xero's collaborative features are designed to transform your relationship with your accountant or bookkeeper, making tax time a smoother, more efficient, and less stressful process for everyone involved. As we discuss this topic, it is crucial to understand the distinct roles at play. Your role is to accurately record your business's financial activity. Xero's role is to be the platform where this data is organized. Your accountant's role is to provide professional expertise, interpret this data, and offer the specific tax advice you need to prepare and file your return accurately and in compliance with the law. This chapter is about using Xero to make the connection between your data and your accountant's expertise as seamless as possible. The single most powerful collaborative feature in Xero is the ability to give your accountant direct access to your books. Gone are the days of exporting messy spreadsheets or handing over a shoebox full of receipts at the end of the year. Instead, you can invite your accountant to be a user in your Xero organization. The process is simple and secure. You navigate to your organization settings, find the Users section, and click Invite a User. Here, you will enter your accountant's name and email address. The most important step is assigning them a user role. Xero has a specific role built for this purpose called Advisor. The Advisor role grants your accountant full access to all the accounting features. They can reconcile transactions, fix miscategorizations, post manual journal entries for things like depreciation, and run any report they need. However, this role does not give them permission to change core business settings or, importantly, to authorize payments from your bank account. It gives them the access they need to do their job while protecting your control over the business. Once your accountant accepts the invitation, the way you work together changes fundamentally. Instead of being a once-a-year data entry clerk for your business, your accountant can become a proactive partner. They can log in periodically throughout the year, perhaps quarterly or monthly, to review your books. They can spot a potential issue, like a consistently miscategorized expense, and fix it in minutes, rather than discovering it months later. This real-time access fosters a more continuous and advisory relationship. Xero also has specific tools built to enhance this collaboration. Remember the Discuss tab on the bank reconciliation screen? That is your direct line of communication to your accountant on a per-transaction basis. If you encounter a purchase and you are genuinely unsure how to categorize it, you don't have to guess. You can leave a comment in the Discuss tab such as, "Hey, this was for a business development course. Which account should this go to?" Your accountant will see the note the next time they log in, and can categorize it correctly or reply with instructions. This collaborative spirit extends to other documents as well. You can leave notes on specific bills, invoices, or expense claims, creating a clear conversational thread tied directly to the source document. When it comes to the year-end tax preparation process, this collaborative setup truly shines. Your primary responsibility is to ensure that all your bank and credit card accounts are fully reconciled up to the last day of the financial year, December 31st. Once you've done your part, your accountant can take over. They will log in and perform their year-end review. They can run the profit and loss and balance sheet reports we discussed in the last chapter. They will review your expense categories to ensure they are reasonable and to spot any potential deductions that may have been missed. They will make any necessary year-end adjusting entries. Because they have full access, they can drill down into any number they see on a report. If the office supplies total looks high, they don't have to call you and ask for a list of transactions. They can simply click on the number in the report and see every single transaction that makes up that total. This level of transparency and direct access saves an incredible amount of back-and-forth communication. Ultimately, your accountant will use these accurate, well-organized reports from Xero as the source of truth to prepare your business's tax return. The final tax forms themselves are completed outside of Xero, but the data that populates them comes directly from the work you've done in the software all year long. In our next chapter, we will explore some of Xero's features that go beyond core bookkeeping and tax prep. We will look at how you can use Xero's project and job tracking tools to monitor the profitability of specific jobs or projects. Thank you for your time. I will see you in Chapter 9. Hello and welcome back. In our journey through Xero, we have mastered the core accounting functions necessary for tax compliance and understanding your overall financial health. We know how to produce a profit and loss statement that tells us if the business as a whole is profitable. But for many businesses, especially those that are service-based like creative agencies, consultants, or construction trades, a crucial question remains. Which of my specific jobs are actually making me money? In this chapter, we will explore a feature designed to answer that very question: Xero projects. As we dive into this tool, please remember that our focus is on its functionality within the Xero platform. This is an educational guide on how to track profitability per project. It is not business advice on how you should price your jobs, manage your projects, or which clients you should work with. Those strategic decisions are yours to make, using the data this tool can provide. Xero Projects is an integrated solution that allows you to track the time and money you spend on specific jobs, and then invoice for them, giving you a real-time view of your profitability on a project-by-project basis. For many Xero plans, this is an included feature, but you may need to enable it first. Let's begin by creating our first project. From the main navigation, you will find a Projects menu. Here, you can start a new project. You'll give it a name, perhaps Johnson Residence Kitchen Remodel, or Website Design for ABC Corp., and assign it to a customer from your contact list. You can set a budget and give the project a status, such as draft, while you are still quoting. In progress once work begins, and closed when it's complete. Once a project is created, it becomes a container into which you can start putting all related costs and income. Let's talk about tracking costs first. There are several ways to do this. Let's say you receive a bill from a subcontractor who did work on the project. When you enter that bill into Xero, just as we learned in Chapter 6, you will now see an additional column or field called Project. You can simply select the correct project from a drop-down list, and Xero will immediately assign that cost to that job. The same applies to materials. If you go to a hardware store and buy supplies specifically for that kitchen remodel, when that transaction comes through your bank feed, you can create the expense and assign it directly to the Johnson Residence project. Beyond direct costs, the other major component for many businesses is time. Xero Projects allows you to track the time you and your team members spend on a job. You can enter time manually, or use a start-stop timer within the project's mobile app. Each team member can have a cost rate associated with their time, which represents the internal cost to your business for their work. When time is tracked against a project, this cost is automatically calculated and added to the project's total expenses, giving you a much more accurate picture of the true cost of the job. Now for the income side. Xero Projects is fully integrated with invoicing. From within the project itself, you can generate invoices for your client. This gives you flexibility. You could create an invoice for a deposit or an upfront percentage. You could invoice for the total agreed-upon project amount for a fixed-price job. Or for time and materials jobs, you can create an invoice that automatically pulls in all the tracked time and expenses that you wish to bill to the client. This direct link between your tracked work and your invoice ensures that nothing gets missed. Here is where the magic happens. As you add costs and create invoices, Xero is tracking everything in the background. On the main project's dashboard, you will see a list of all your jobs. For each one, Xero displays a clear, real-time financial summary. You will see the total costs you have incurred so far, the total amount you have invoiced, and most importantly, a constantly updated calculation of the project's profit and its profit margin, shown as a percentage. This at-a-glance view is incredibly powerful. You no longer have to wait until the end of the year and guess which jobs were successful. You can see, right now, that the website design project is running at a healthy 40% margin. But the kitchen remodel is facing cost overruns, and the margin has slipped to 15%. This insight allows you to make better informed decisions in the future, helping you quote new work more accurately and understand which types of jobs are truly driving your business's success. In our next chapter, we will shift our focus from service-based businesses to managing another common business need. We'll explore the tools Xero provides for team members to submit expenses for reimbursement, streamlining the process of handling out-of-pocket costs. Thank you for your time. I will see you in Chapter 10. Hello and welcome back. In our previous chapters, we've covered how to track the major costs in your business, from supplier bills to the detailed expenses associated with specific jobs in Xero Projects. However, there is another category of spending that can often create administrative headaches: out-of-pocket expenses paid for by you or your employees. This could be anything from a team member buying coffee for a client meeting to an employee paying for a hotel on a business trip. In this chapter, we'll explore how to manage this process efficiently using Xero expenses. Before we begin, it's important to clarify our scope. We will be demonstrating the workflow and features of the Xero expenses tool. This presentation is not advice on what your company's expense reimbursement policy should be, nor is it tax advice on what constitutes a deductible business expense. Those are matters for your company's internal policies and for discussion with your tax professional. Our goal is to show you a more streamlined way to handle the administrative side of these transactions. The traditional way of managing expense claims is often messy. It involves employees collecting paper receipts, filling out spreadsheets, and emailing them to a manager for approval. It's a process that is slow, prone to errors, and can result in lost receipts and delayed reimbursements. Xero Expenses is designed to replace this outdated workflow with a simple, digital, and fully integrated system. Let's look at the process from both sides, starting with the employee who is submitting the expense. The primary tool they will use is the Xero Me mobile app, which is separate from the main Xero accounting app. An employee can be invited to use Xero Expenses without needing access to the company's core accounting data. Imagine your employee has just paid for parking for a client visit. Instead of stuffing the receipt in their wallet, they can immediately open the Xero Me app. The app's key feature is its receipt capture technology. The employee takes a photo of the receipt, and Xero uses optical character recognition, or OCR, to automatically scan the image and extract the key information: the vendor's name, the date, and the total amount. The employee then simply reviews the auto-populated data, adds a description, and crucially selects the appropriate expense account from a list that you, the administrator, have made available to them. For example, they would choose travel expenses or meals and entertainment. If that expense was for a specific job, they can even assign it directly to a project, linking back to what we learned in the last chapter. Once everything is correct, they hit submit, and the claim is instantly sent for approval. Now let's shift to the perspective of the business owner or manager who approves these claims. Back in the main Xero platform, submitted expense claims appear in a queue, waiting for your review. You can see who submitted the claim, the amount, and the date. You can click into the claim to see all the details, including the digital copy of the receipt the employee attached. You can verify that it was coded to the correct expense account and assigned to the right project. From here, you have a simple choice: approve or decline. If you decline it, you can add a note explaining why. Once you approve a claim, the process integrates seamlessly with the rest of your accounting system. This is the most powerful part. Xero automatically creates a bill in your Bills to Pay section. The bill is from the employee, as they are now a vendor you need to pay, for the total amount of their approved expenses. This means that reimbursing your employees becomes part of your standard bill payment workflow, which we covered in Chapter 6. You can pay that single reimbursement immediately, or you can wait and pay all employee reimbursements at the end of the month as part of a batch payment, along with your other supplier bills. The final step, as always, is reconciliation. When the reimbursement payment leaves your bank account and appears in your bank feed, Xero will suggest a match to the bill that was created for the employee. You click OK, and the entire process is complete. You now have a perfect digital audit trail, from the initial photo of the receipt to the final bank reconciliation, all neatly tied together in your accounting system. In our next chapter, we will delve into another important aspect of bookkeeping, particularly for year-end and tax preparation: managing your company's fixed assets and understanding how Xero can help track their value and depreciation over time. Thank you for your time. I will see you in Chapter 11. Hello and welcome back. So far in our series, we have primarily focused on the day-to-day flow of money in and out of your business, your income and your operating expenses. But what about those large, significant purchases that provide value for years to come? Things like a new company vehicle, powerful computers for your team, or specialized machinery. These are not simple expenses, they are fixed assets. In this chapter, we will explore how Xero helps you manage these assets and handle the crucial accounting concept of depreciation. This chapter contains topics that are highly specific to accounting standards and U.S. tax law. It is absolutely essential to understand that we are demonstrating the features of Xero's fixed asset register tool, not providing tax or accounting advice. The rules governing depreciation, including the useful life of an asset and the appropriate depreciation method to use, are complex and have significant financial implications. Decisions on how to depreciate your assets must be made in consultation with a qualified tax professional. Our goal is to show you how to enter those decisions into the software once they have been made. So what is a fixed asset? It's a significant physical item that your business owns and uses to generate income, which has a useful life of more than 1 year. When you buy a laptop for $1,500, you don't record it as a one-time expense in the month you bought it. Instead, you record it as an asset on your balance sheet, and then you spread its cost over its expected useful life. This process of allocating the cost is called depreciation. Xero has a dedicated tool for this called the Fixed Asset Register. Let's walk through the life cycle of an asset. Imagine you've just purchased that new $1,500 laptop. The purchase will appear in your bank feed. When you categorize this transaction, instead of choosing an expense account like office supplies, you would code it to an asset account on your chart of accounts, which might be called computer equipment. This action places the value of the laptop onto your balance sheet. The next step is to formally add it to your fixed asset register. You can find this by going to the accounting menu, selecting Advanced, and then Fixed Assets. Here you can create a new asset. You will give it an asset number and name like Dell XPS 15 laptop, and enter the purchase date and price. Now comes the critical part: setting up the depreciation rules. This is the information your accountant will provide. You will need to enter the asset type, which helps group similar items. Then you'll enter the useful life, in years. For example, a computer might have a useful life of 3 or 5 years according to tax guidelines. Next, you must select the depreciation method. Xero offers several standard options. For example, the straight-line method spreads the cost evenly across the asset's life. If the laptop has a 5-year life, this method would expense $300 of its value each year. Another option might be a declining balance method, which expenses a larger portion of the asset's value in the earlier years, and less in the later years. Your tax professional will determine the correct method based on the asset type and current tax law, which might also include special rules like bonus depreciation or Section 179 expensing. You simply select the method they advise in Xero. Once your assets are registered with their depreciation rules set, the hard work is done. Xero automates the calculations. At the end of each month, or at the end of the year, you or your accountant will go into the Fixed Asset Register and see a button that says Run Depreciation. When you click this, Xero calculates the correct amount of depreciation for that period for all your registered assets. It then automatically posts a journal entry in the background. This entry does two things. First, it records the depreciation as an expense on your profit and loss statement, which reduces your taxable income. Second, it reduces the book value of your asset on the balance sheet in an account called Accumulated Depreciation. This keeps your financial statements accurate. The Fixed Asset Register also handles the end of an asset's life. If you eventually sell or dispose of the laptop, you can record this in the register. You'll enter the date and the amount you sold it for. Xero will then calculate if you made a gain or a loss on the sale, remove the asset from your books, and record the financial impact correctly. In our next chapter, we will tackle the complexities that arise when your business operates on a global scale. We'll explore how Xero is equipped to handle transactions and reporting in multiple currencies. Thank you for your time. I'll see you in Chapter 12. Hello and welcome back. In today's interconnected world, it's more common than ever for even small businesses in the United States to work with international clients or purchase supplies from overseas vendors. This introduces a new layer of complexity to your accounting, handling transactions in different currencies. In this chapter, we will explore how Xero's multi-currency features are designed to simplify this process, allowing you to seamlessly manage international business. Before we proceed, it is essential to state that this chapter is a guide to the software's functionality. It is not financial advice on managing foreign exchange risk, nor is it legal advice on your international tax obligations. Currency exchange rates fluctuate constantly, and these fluctuations can create real financial gains or losses for your business. We recommend discussing strategies for managing these risks with a qualified financial advisor. The multi-currency feature is typically available on Xero's more advanced subscription plans. The first step, if you haven't already, is to ensure your home currency is set correctly to United States dollars (USD). This is the baseline currency for all your primary financial reporting. Once your home currency is set, you can add any other currencies you expect to transact in. Under your accounting settings, you'll find a section for currencies.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Here, you can add currencies like the Euro, the British Pound GBP, the Canadian Dollar CAD, or the Japanese Yen JPY. When you add a currency, Xero automatically begins pulling in daily exchange rate data from a trusted third-party provider, which is the engine that powers this entire feature. Let's see how this works in practice, starting with an invoice for an international client. Imagine you need to bill a client in Germany for 1,000 euros. When you create a new invoice, you will now see a currency drop-down menu at the top. You can switch this from USD to Euro. You will then enter the line items and prices in euros. The invoice that gets sent to your client will be for 1,000 euros. In the background, Xero does something very smart. It records the invoice on your books in euros, but it also records the home currency, USD, equivalent based on the exchange rate for that specific day. So your accounts receivable will show that you are owed 1,000 euros, and your reports will reflect its current value in dollars. The same principle applies to bills. If you receive a bill from a UK-based supplier for 500 British pounds, you can enter that bill into Xero in its native currency of GBP. Xero will track that you owe your supplier 500 pounds, and will show the corresponding liability in US dollars on your balance sheet. The true power of this feature becomes clear during bank reconciliation, when payments are made or received. Let's go back to our 1,000 euro invoice. A few weeks after you sent it, your client pays. The money arrives in your US bank account, but it arrives as, for example, 1,080 US dollars. However, on the day you created the invoice, the exchange rate might have meant that 1,000 euros was only worth 1,050 US dollars. This $30 difference is a realized currency gain. You don't need to calculate this manually. When the payment appears in your bank feed, you will match it to the 1,000 euro invoice. Xero will see the difference between the value at the time of invoicing and the value at the time of payment, and it will automatically calculate the $30 gain and post it to a specific, realized currency gains and losses, account on your profit and loss statement. This keeps your books perfectly balanced. The system also tracks unrealized gains and losses. For example, if you have an unpaid 1,000 euro invoice on your books at the end of the month, and the exchange rate has changed, the USD value of that invoice has also changed. Xero's reports can calculate this change in value automatically, giving you a true picture of your financial position at all times, which is essential for accurate accrual basis accounting. In summary, Xero's multi-currency feature automates a highly complex area of accounting. It allows you to transact in foreign currencies with ease while keeping your home currency reports accurate by automatically handling exchange rate conversions and calculating any resulting gains or losses. Now that we've explored the complexities of international transactions, in our next chapter, we'll turn our focus inward and look at a powerful tool for planning your financial future. Setting up and tracking a budget in Xero. Thank you for your time. I will see you in Chapter 13. Hello and welcome back. For the majority of our journey together, we have focused on accurately recording the financial history of your business. We've tracked what has already happened, the sales you've made, the bills you've paid, and the assets you've acquired. Now we're going to shift our perspective from looking in the rearview mirror to looking ahead through the windshield. In this chapter, we will explore how to use Xero's Budget Manager to create a financial plan and track your progress against it. It is very important to note that this chapter is a guide on how to use the budgeting tools within the Xero software. It is not financial advice on how to set your business goals, how much you should spend, or what constitutes a good budget. Creating a meaningful budget requires a deep understanding of your specific industry, market, and business strategy. For advice on financial planning, we strongly recommend consulting with a business advisor or financial professional. A budget is, in simple terms, a financial plan for a future period, typically a year. It's an estimate of your expected revenue and anticipated expenses. By creating a budget, you set financial goals and create a benchmark against which you can measure your actual performance. Xero's Budget Manager is the tool that facilitates this. You can find the Budget Manager under the Reports section. When you open it, you will be prompted to create a new budget. You'll give it a name. You might simply call it 2026 Annual Budget, and select the time period it covers. You'll then be taken to the main budgeting grid. The layout will feel familiar. It looks much like a spreadsheet, with the months of the year displayed across the top as columns, and your chart of accounts listed down the side as rows. Now, you need to populate this grid with your financial plan. You can start from scratch and manually type your expected income and expense figures into each cell for each month. For instance, you might budget $10,000 in sales for January, $1,500 for rent every single month, and $500 for marketing in the first quarter. However, to make this process easier, Xero provides some helpful shortcuts. Instead of starting with a blank slate, You can choose to pre-populate the budget with actual historical data. For example, you can import your actual results from the previous year. This provides a realistic baseline to work from. You can then adjust these historical numbers to reflect your plans for the upcoming year. Once you have a baseline, you can apply formulas to adjust the figures quickly. Let's say you want to budget for a 10% increase in sales over last year. You can apply a formula to the sales line to increase all the monthly figures by that percentage. Or, if you have a consistent expense like a software subscription, you can enter the amount for the first month and have Xero apply that same amount across all subsequent months. After you have saved your budget, the most valuable part of the process begins: comparing your plan to reality. The primary tool for this is the Budget Variance Report, which you can also find in the Reports section. This report is designed to be run after a month or quarter has concluded. When you run the report, it will show you several columns side by side for each account. You will see the actual amount that you spent or earned, the budget amount that you had planned, the variance, which is the dollar difference between the two, and often, the variance as a percentage. This report instantly highlights where your financial performance aligned with your plan, and where it differed. It gives you clear, data-driven insights, showing you that perhaps your sales were 5% over budget, which is great, but your advertising costs were 20% over budget, which is something you may want to investigate. A budget is not meant to be a rigid document set in stone. As the year unfolds, business conditions can change. Xero allows you to easily go back into the budget manager at any time to adjust your figures for the remaining months of the year, ensuring your financial plan remains a relevant and useful tool. You can even create multiple versions of a budget to plan for different scenarios, such as a conservative plan versus an optimistic growth plan. In our next chapter, we will shift our focus to businesses that sell physical products. We'll explore how to use Xero's inventory management features to track stock levels and the cost of goods sold. Thank you for your time. I will see you in Chapter 14. Hello and welcome back. In our recent chapters, we've explored features like project tracking and budgeting that apply to a wide range of businesses. Now we're going to turn our attention to a topic that is absolutely essential for any business that buys, holds, and sells physical goods: inventory management. Accurately tracking your stock is not only vital for knowing what you have available to sell, but it's also a critical component of accurate financial reporting and tax preparation. Before we dive in, it is especially important to underscore that this chapter is a guide to the inventory tracking tools within Xero. Inventory accounting and valuation are complex areas with specific rules set by the IRS. You should always consult with a qualified CPA or tax advisor to ensure your inventory management practices are compliant and appropriate for your business type. Our purpose is to show you how to execute your chosen strategy within the software. Within Xero, when you set up items under products and services, you have two fundamental choices. You can treat them as untracked or tracked items. Untracked items are useful for services or products where you don't need to manage stock levels. It saves you from retyping the description and price on every invoice, but it doesn't have any impact on your inventory valuation. The real power for product-based businesses comes from using tracked inventory. When you designate an item as tracked, you are telling Xero to actively monitor its quantity and value. Let's walk through setting up a new tracked item. You'll navigate to Business, and then Products and Services. When you create a new item, you will see a checkbox that says, "I track this item." Checking this box opens up a few extra fields. You will need to assign 3 specific accounts from your chart of accounts. First, the inventory asset account, which is a current asset on your balance sheet that represents the total value of the stock you own. Second, the cost of goods sold account, which is an expense account on your profit and loss statement. And third, your standard sales or revenue account. Once an item is set up this way, the accounting for it becomes highly automated. Let's follow the workflow. First, you purchase new stock. You receive a bill from your supplier for 20 units of your tracked item at a cost of $10 each. When you enter this bill into Xero and approve it, 2 things happen automatically. Xero increases your quantity on hand for that item by 20, and it increases the value of your inventory asset account by $200. Now let's say you sell 5 of those units to a customer. You create a sales invoice for the 5 units at your sales price. When you approve that invoice, Xero once again does 2 things in the background automatically. First, it records the revenue in your sales account, just like any other sale. Second, and most importantly, it decreases your quantity on hand by 5 and simultaneously moves the cost of those 5 units, which is $50, from your inventory asset account on the balance sheet to your cost of goods sold account on the profit and loss statement. This automation is the core benefit of the feature, ensuring your financial statements are always in sync with your stock movements. It is important to understand the method Xero uses to value your inventory. Xero uses the average cost method. This means the cost of an item is calculated as the weighted average cost of all the units you currently have in stock. If you buy your first 20 units at $10 each, and later buy 20 more at $12 each, Xero doesn't separate them. It calculates the average cost of all 40 units as $11 each. When you sell one, it will record the cost of goods sold as $11. This is the method built into the software. Xero also provides reports to help you keep an eye on your stock. You can run an inventory item summary report to see the quantity on hand, the total value, and the average cost for all your tracked items. You can also make inventory adjustments for situations like performing a physical stock count and discovering a discrepancy, or for writing off damaged goods. In our final chapter, we will bring our entire journey together. We'll summarize the key pillars of managing your business finances in Xero, and offer some final thoughts on best practices for maintaining clean and accurate books all year round. Thank you for your time. I will see you in the final chapter. Hello, and welcome to the final chapter of our comprehensive guide to the U.S. tax and accounting features of Xero. We have come a long way on this journey. We started with the fundamental setup of your organization, progressed through the daily rhythms of managing transactions, invoices, and bills, and explored advanced features like project tracking, multi-currency, and inventory. Our goal has been to empower you with a deep understanding of how this powerful software works. In this concluding chapter, we will distill everything we've learned into a set of core best practices for maintaining excellent bookkeeping hygiene year-round. Before we summarize, it is essential to state one last time that this audio series has been for informational and educational purposes only. It is a guide to a software tool. It is not, and should not be considered, a substitute for the advice of qualified professionals. Your business's financial health and tax compliance depend on advice tailored to your specific situation from a certified public accountant, a tax advisor, and a legal professional. The goal of good bookkeeping is to provide these experts with the clean, accurate data they need to give you the best possible advice. Let's distill our learnings into 4 key pillars of bookkeeping excellence. Pillar number 1, consistency. If there is one word to remember from this series, it is consistency. The value of your financial reports is directly tied to the consistency of your data entry. This means consistently categorizing similar expenses to the same account every single time. A subscription to a marketing software should always go to your software and subscriptions account, not sometimes there and sometimes in advertising. The best way to enforce this is by using the bank rules feature we discussed in Chapter 3. By creating rules for your recurring transactions, you ensure they are categorized the same way every time, building a reliable and meaningful dataset. Pillar number 2, timeliness. The second pillar is timeliness. It can be tempting to let your bookkeeping pile up and plan to catch up at the end of the month, or even worse, at the end of the quarter. This is a recipe for stress and errors. The most effective approach is little and often. Dedicate just 10 to 15 minutes at the beginning or end of each business day to reconcile the latest transactions in your bank feed. This small, consistent habit prevents the task from becoming overwhelming. It also provides the immense benefit of giving you a real-time, accurate view of your cash flow, which is invaluable for making day-to-day business decisions. Pillar number 3, accuracy and detail. The third pillar is a commitment to accuracy and detail. This means going beyond just categorizing a transaction. It means attaching a source document whenever possible. Use the Xero mobile app to snap a photo of a receipt the moment you get it. Forward digital bills and receipts directly to your Xero account. By attaching a digital copy of the source document to every transaction, you create a complete, unassailable, and audit-proof record. Should you or your accountant ever need to verify a particular expense months or even years later, the proof is right there, just a click away. Pillar number 4, collaboration. Finally, our fourth pillar is collaboration. Remember that modern accounting software is not just for you. It's a platform for you and your financial advisors to work together. Invite your accountant or bookkeeper as an advisor user in your Xero account, as we covered in Chapter 8. Lean on their expertise. Use the Discuss tab to ask questions about transactions you don't understand. By giving them real-time access, you transform your relationship from a stressful, once-a-year data dump into a proactive, year-round partnership focused on the health of your business. By embracing these 4 pillars, consistency, timeliness, accuracy, and collaboration, you transform bookkeeping from a chore into a powerful business habit. You create a system that not only prepares you for a smoother tax season, but also provides you with the clear, reliable financial insights you need to run your business with confidence. You have invested your time in learning this tool, and now you have a comprehensive understanding of how to build and maintain a world-class accounting system for your business. Thank you for joining me on this journey through Xero. I wish you the very best in your business endeavors.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.